Meantime, we do want to get some more about the president's comments made in just the past half hour or so. He said, quote, "I think the Fed has gone crazy." We want to bring in former Dallas Fed President Richard Fisher, who joins us on the Fast Line. Dick, great to have you with us. So what should we when you hear these comments, what did you think?
Nothing. I would ignore them. I don't think, look, we've heard these comments before. He was a little more gentle in what he said the other day. But he made it very clear he doesn't talk to Jay Powell. He doesn't try to communicate with the Fed. They have to do their job. It's his personal feeling. We've gone through this a couple of times now, and it's had, in the end, no impact. So I don't think that's what's moved the market. His reaction to it, obviously, is his own reaction. But I know how tough Jay Powell is, and I also know how the FOMC, as a committee, views its mission. They're all sincere about it. It's a non-political institution, and they will not buckle to the president's wishes.
I understand that. At the same time, Richard, do you think that the Fed should take into consideration the different kinds of inflation that we may be seeing in this market? We had a very spirited debate here on this desk about whether or not the inflation was organic to the growth of the U.S. economy or self-inflicted via the tariffs and the sanctions on Iran, which have driven up oil prices. Is there a distinction in your view in terms of how the Fed should think about inflation and what kind of inflation the Fed should be hiking into?
Well, remember, the Fed cuts out what happens on the energy front, and, as you know, cuts to the core. The economy is robust. We see the NFIB, the National Federation of Independent Business, release a report just at dawn saying how incredibly encouraged those people that employ a little over 50% of all the workers in America. By the way, they're not listed companies. They don't trade in the markets, but they are the backbone of the U.S. economy. So the real economy seems to be doing quite well. The inflationary pressure, the Fed looks at expectations. The expectations are rather mild right now, still around the 2% level. And then we'll have to see what happens in terms of total comp, which, as we know, is rising significantly more than 2%. But the trade stuff hasn't yet kicked into the system. It probably front-loaded a little economic growth due to inventory build. But we haven't seen the inflationary impact yet. And I just want to make one other comment here, because we're all interested in what happens in markets. The Fed gave our nation and the market operators a huge gift. And that gift was given when we expanded the balance sheet by $1.75 trillion by last week in February of 2009. The market bottomed, the S&P at 666, the Book of Revelations number, as we like to call it back then. And it's been on a tear ever since. So I don't think the Fed, and particularly Jay Powell, given his background in credit markets, capital markets, is going to shed a tear because the market has corrected. It may go back up. It may correct even further. This has been a one-way street for a very long time, and nobody who has any common sense has been living without an expectation that at some point you'd have, obviously, dramatically new volatility and some kind of price reset.
Right.
The Fed cares only about if it affects the real economy.
Sure.
Right now, the real economy is doing well.